Okay, so let's start the chapter. PSP or payment system providers will be covered during this chapter 11, which is payment system for electronic commerce. The learning objective in this chapter is about what the most common online payment systems are and how they function. How payment cards are used in online retail transaction, what stored value cards are, and how they are used in electronic commerce, what challenges and opportunities are presented by the use of digital cash. Also, we'll learn in how digital wallets facilitate online transactions through the computers and mobile devices, and how the banking industry use the internet technology. So, fintech or financial technology is the use of a powerful internet-connected computers that use tools to improve quality and reduce the cost of services. Existing and entirely new financial products, they can do that, correct? And also includes online payment system not operated by banks. So in these type is like facilitates purchase and other money transfers. It's convenient and becoming widely adopted. It also has revolutionized lending, by the way, and such as online loan services takes banks out of the value chain at a reduced cost. The common online payment method is, as you know, is cash, checks, credit cards, debit cards. But you know, cash is not online, but cash, checks, credit card, debit card that are most common payment methods are the most used to pay for the purchase. And more than 90% of all US consumers payments is done through these. Electronic transfer is a small percentage of that, mostly automated payment from checking accounts. So you do electronic transfer through the checking account. And then you have what you call a credit and debit card used for more than 60% of online payments, with alternative systems such as a PayPal you find and One Global or OG used for the remainder. The convenient for customers and the cost-effective for businesses and provides a significant environment impact, and we could bring the OG experience in Iraq or the payment services. Now, these are, in other words, if you look at it, or the whole electronic payment, there is a prepaid card, which is 10%, store branded cards, probably 6%, credit card, almost 40%, debit card is 28%, and alternative payment method like a PayPal is a 20%. So this is how it's been happening recently. So electronic bill presentment and payment system. It is designed to deliver bills and accept payment. Success depends on ease of use and time required also. Mostly it's a 30-second. consumers choosing this option is increasingly now, much more now than 70% of the bills paid by uh, that used to be paid by check are now paid electronically, which is a huge saving in papers, postage, and time. Very few people have checkbooks anymore. Biller direct system are also used by large companies who want to manage the system themselves. There is some kind of a consolidator systems also aggregate all a customer's bills on one system, mostly via bank. And but that's not attractive, not as attractive to a biller because it requires a fees and delays of receipt because you can have to aggregate all these receipts of funds. The micropayment and the small payment. Micropayment are internet payment for the item costing few cents to a dollar, or maybe more a little bit. Now there is some kind of you can get some perfumes at the payments, micropayments also. But the barrier is people usually known for prefer to buy small value items in a fixed price chunk rather than small payments in a varying amounts. Now, many companies have developed a micropayment system, but none gained a broad acceptance so far. Small payments are payment for less than $10 monthly or daily or yearly, whatever. It's offered through a mobile telephone carrier, but held back by substantial charger for the provider services. It's like the iPhone case. One of the largest market is music download, basically. But then you have what you call the payment cards, which is all of us use it. Payment cards are plastic card used for purchases, such as a credit card, debit card, charge card, prepaid card, and gift card, and we can name a few of them. The credit card are kind of like a Visa and MasterCard have a spending limit based on the user credit histories. Pay off the entire credit card balance or a minimum amount for the interest charge on unpaid balances. That's the monthly. It's widely accepted and provide consumer protections. It's 30 days you can do a dispute period. And that's the reason, one of the reasons why you do that. The debit card, on the other hand, is electronic fund transferred at the point of sales or EFT POS or POS, point of sales. Removes funds from a cardholder's bank account to transfer it to a seller or the merchant account. Is usually issued by a bank with a major credit card issuer's name. There is another credit card, which is called a charge card, which is American Express. They have a charge card and they have the credit card. Has no spending limits with the entire amount due at the end of the billing period. So there's two types, American Express, one credit card, one charge card. The retailers may offer their own store also charge card. A prepaid cards are called gift cards, and we can find them a lot around. Single-use card also has a disposable numbers after a few purchases or after depleting the amount. Is valid for one transaction could be, but not adopted by consumers also. A single-use card. The advantage and the disadvantage of payment card. The advantages for merchants include a fraud protection, can be authenticated and authorized purchase using a payment card processing network. So what's happened, there is no, when you write a check, you might have non-sufficient fund, but in this one, no, you can, it's controlled. The other advantage is the consumer is also limited to a fraud which is $50, which is often waived if the card is stolen, or you can dispute it and they return it back. Merchants view the per transaction and monthly processing fees as a cost of doing business, and that's two ways of looking at it. We can explain that. And usually consumers pay a slightly higher cost for the goods to these cards, and some charges an annual fee in it. Between 50, 30, you have 150, 120, 240s, depending on the card and the limit on it. The online and mail order stores must ship the merchandise within 30 days of charging, because they have 30 days of dispute. So any significant violation penalties. So the most stores charge account when the order ship. If it takes longer, when the order is shipped, they charge it. A processing payment. Processing payment card transaction online has two steps. You do it in two steps. One is a payment acceptance, and is about establishing card validities and verifying card limits is not exceeded by the transaction, and we can explain how this works. And the second is clearing the transaction, include all the steps to move funds from the cardholder's bank account into the merchant bank account, and we will talk about that more in detail, how it works. But overall, we have an open and a closed loop system. With a closed loop system, the card issuer pays the merchant directly without a bank or a clearance house, like the American Express, Discover card, and they charge the client. They issue the card directly to consumers. With the open loop system, add additional payment processing intermediaries to the closed loop system. So Visa and MasterCard issued by a local bank, but the original issuer is the Visa and MasterCard. Visa and MasterCard are credited card associated, operated by issuing bank that evaluate credit standing, establish the credit limit, and absorb the non-payment losses. And this is how it looks like in a closed loop payment card. We'll explain that. And then we have the open loop or open loop payment card, which is the Visa and MasterCard. The first one might be a closed loop. We'll explain that too. Merchant account. Acquiring bank does business with the seller that want to accept the payment card. Business must set up a merchant account with the acquiring bank to process the internet transaction. Acquiring bank is the bank who received the money from the seller bank. Obtaining account requires the merchant to provide a business information and the bank to assess the risk also. The chargeback occurs when the cardholder successfully contests the charge. Acquirer fees are charged for providing payment card processing service per month, and transactions set by the acquiring bank. Could be per month or per transaction or a combination of both. The interchange fees are charged at the rate that depends on the merchant industries, and it's set by the card association, charged to acquiring bank, and usually passed along or to merchant. The level of the fraud in this is much higher online, under 15% of all the credit card transactions responsible for 60% of the total dollar amount of credit card fraud, declined since 2006. So there's lots of fraud happening with the credit card. The anti-fraud measures include scoring services that provide a risk rating for individual transaction in a real time. We'll explain that how, for example, RBC does it. Shipping only to card billing address and require card verification number, CVN, for a card not presenting a transaction. Now, there are a 4 or 3-digit number printed on the credit card behind or in the front, but not encoded in the card magnet strip, so nobody can copy it. Payment card processing. Most online merchants accept both closed loop and open loop systems card, and some accept a direct deduction from the customer's checking account. Can be done that. The automated clearing house is a network of banks involved in direct deduction and transaction on a daily basis, probably supervised by central bank. Processing depends on the size of the transaction. Large build and manage their own system. If they have a lot of processing, they build and manage their own system. If they're mid-size, use purchase softwares with the skilled staff to manage the system. And the smaller ones rely on the service payment processing service providers. The front-end processor or payment gateway obtains and stores transaction authorization. The back-end processors, and that's within the system of PSP or payment service providers, or could be the bank. So there is a payment gateway, and there is a back-end processor takes a front-end processor transaction and coordinate the inflow information, handles probably the chargebacks and other reconciliation items through the interchange network, and acquiring and issuing a bank. Some processors handle all the elements of payment processing and others specialize in one element or particular industries. No one company provide a level of comfort to about one place does it all. There is another one is called the stored value card. And the stored value card is another plastic card with an embedded microchip that can store information and perform calculation. We do have now microchips on most of the cards. Most of incorporated near NFC communication. So near field communication stands for the NFC's technology, which allows for a contactless data transmission over the short distance when you're tapping the codes. It uses the technology of RFIDs and allows interaction with the readers and other devices. It also can hold much more data than a magnetic card and has a safer because the data can be encrypted. I can explain what's an RFID and how it works. Then when we have the digital cash, it's also called the electronic cash or e-cash. It's describe any value of a storage and exchange system created by private non-governmental entity. Does not use a papers, document, or coins. Can, like a Bitcoin, can serve as a substitute for government issue physical currencies. No common standard adopted so far, and none adopted so far. Can be held in online storage or offline storage also. The advantage of this is can be more efficient, less costly than the traditional payment method, and also no audit trail, which is makes it non-traceable, which can lead to money laundering also. Convert the illegal obtained money into money spendable without being linked to illegal activities in a way. And then when we have a digital wallet like e-wallet and software-based digital wallets, which allows the customer to store name, address, credit card information on the electronic device or software. The benefit is the customer enter the information just once, is always going to read it. Server-side digital wallet stores information on the remote server of the merchant and the wallet publisher. So it's data is somewhere else. The security breach can reveal thousands of users. This is the problem. Personal information to unauthorized parties. And has to be audited by a third party. So there's a list breach. And samples like we can look at is a Google Wallet, Microsoft Windows Live ID, Yahoo Wallet, and the digital or the e-wallet. The client-side digital wallet stores information consumers' computer must download the wallet software onto every computer. Hardware-based digital wallet. It's implemented using a smartphone or tablet, usually. Stores owner identity credentials like a driver license, medical insurance card, and store loyalty card, all these can. And they have a KYC, know your customer process. The transmit portion of information using the Bluetooth or wireless transmission to nearby terminal is happening also. They can do that. And the near-field communication, which is NFC technology, can be used if equipped with NFC chip. Google Wallet, once again, Android Pay and Apple Pay do that, NFC. The security and the privacy are major concerns there, must prevent unauthorized access to it. Mobile banking. Banks exploring mobile commerce potential. Most banks offer apps for mobile devices, like check and transfer balance between accounts, view the statement, find an ATM, make payments. All these can be done through mobile payment. Some banks' apps allow check to be deposited also by the taking a picture of it and gets deposited. The five big banks here, they do that, the big five. Vendors such as GoPayment and Square offers a tiny credit card reader that can be attached to a mobile device to take the payment. The small one, you can put it in the mobile or a wire, and they just can take the payment through it too. Tapping or even through the device. The payment system threat, as usual, phishing and identity theft. Online payment systems offer an attractive arena for criminal enterprises. So phishing attacks are techniques for committing fraud against online business customers, and we'll explain how few types that they do. Phishing attack. Attackers usually send a message or email message to account with a potential for an account at the target website. Email message tells the recipient account compromised and the recipient must log into the correct to correct the problem, and there where they take all this information. Spear phishing is a carefully designed phishing attack targeting a particular person or organization. It's not just trying anybody. Large criminal organization can be highly efficient, and you saw in the video, perpetrators for identity theft. Phishing needs both collectors and cachers, users of information which require different skills. Over 1 million victims and 1.5 billion lost annually worth of money. It's a spam is a key element of phishing attacks. Any protocol change that improves an email recipient ability to identify the message source reduce the phishing. If there's a spam, you can announce it. You can educate website users. You can also contract with a consulting firm specializing in anti-phishing work, monitor online chat rooms used by criminals. Incidence of phishing has grown rapidly over the past 2 years, and the experts expect it will continue. And it's extremely profitable criminal activities, as you saw the video. Thank you very much.